Hey guys, welcome back to another episode of Smart Risk. In this video, we will show you one of our advanced entry strategies which we have developed using smart money techniques, order block and order block. Today, we will show you step by step how to fully apply this trading setup on any chart with all the mechanical rules that need to be followed. This setup begins by identifying an order block as the key trading zone on the higher time frame. Next, we'll confirm reversals by analyzing the lower time frames when the price taps into that area. Finally, we'll trade the order blocks that form along the way until we reach our targets, ensuring high-quality entries. If learning smart money concepts, strategies, entry reasons, and how to stay disciplined with the trading plan interests you, make sure to hit the like button to show your support and subscribe to our channel if you're new. Before we start, here are 2 important points about this trading setup. Everything we discuss in this video can be used for currency trading, stock trading, and crypto, because price action remains fairly consistent across different markets. Second, make sure to fully understand all of the steps we will explain for this trading setup before starting to backtest or trade it on the chart. Because this trading plan is a systematic method that takes into consideration multiple trading concepts for achieving the highest accuracy. Now, let's get started. This trading plan consists of 3 major time frames. First, we have the daily time frame, where we will do a general analysis. We will read the market structure to find key levels and assess how much space we have before reaching an important higher time frame level. Second, we have the 1-hour chart, where we will apply smart money concepts to identify market direction, liquidity levels, fair value gaps, and, more importantly, the order blocks, which are the optimal trading zones that might provide us with a high-quality trading setup. In the final step, we will zoom into our lower time frame, the 5-minute chart, to find confirmation and enter positions. Remember, this trading plan is not limited to any specific chart or time frame. However, you must use a combination of time frames to analyze market factors and gain a comprehensive understanding of market conditions. Step 1. Higher time frame analysis. In the higher time frame, we want to understand where we are in the bigger picture, so we avoid trading blindly on the lower time frame charts. To keep things simple, we focus on marking key levels in the higher time frame and determining how much room we have before reaching the next key level ahead of the current price. These key levels have specific characteristics. Here are some top criteria based on price action. The opposite colored candles. If you examine the trading chart, you'll notice that an opposite colored candle within an impulsive move often acts as strong support or resistance. Institutions and large participants frequently use these candles as the origin to refine their trading plans. Therefore, we always mark these on the chart, especially on higher time frames, and anticipate a reaction when the price taps into these levels. Fair value gaps. If you're a smart money trader, identifying the fair value gap should be one of the first things you do when you open the trading chart. Your eyes should immediately jump to it. But why is it important to identify fair value gaps? These gaps indicate that big players have participated in the market and moved the price significantly. The market often returns to these areas to fill any leftover orders, and if there are still orders remaining, they will typically reject the price upon retesting. Multiple rejections. Multiple rejections from a particular level show that traders have reacted at the same level multiple times, making it stronger. While more rejections increase the strength of the level, they don't guarantee that it will hold. When the market taps into a level, we closely monitor price action to see what's happening. If the rejections weaken over time, the chances of the price breaking through that level increase. However, if the price retests this area again and holds, it becomes strong support. Major levels of market structure. A major level of structure is a zone where 3 conditions are met. It has been rejected multiple times, acted as both support and resistance, and has been recently respected. When these conditions align, we identify it as a major level of structure capable of producing strong market reactions. The more these criteria are met, the higher the probability that the price will reject this level again. By marking key levels on the higher time frames, we can determine how much space we have before reaching the next level. Now, here's an important point. The safest way to make profits in the market is by trading in the empty spaces on the higher time frames. The reason is that most price manipulations occur around key levels. Let me explain what I mean. Imagine this line chart represents our daily time frame. This is the most recent key level ahead of the current price. So we still have plenty of space before reaching this level on the lower time frames. Therefore, we can enter long positions with confidence, knowing that there are no significant levels acting as barriers for the price, speaking purely from a technical analysis perspective, of course. However, the situation is different at key levels. Usually, we see multiple breaks and fakeouts before the market moves in the direction we expect. In other words, manipulations happen most frequently at key levels to trap traders looking to trade support and resistance areas. Afterward, the market often enters the distribution phase so quickly that it doesn't provide a pullback or a good entry point. In conclusion, aim to trade in the empty spaces on higher time frames for a higher success rate. Now that we have analyzed the higher time frame, it's time to zoom into the 1-hour chart and apply smart money concepts. In this analysis, we'll assess the market structure to determine market direction, fair value gaps, liquidity areas, and most importantly, order blocks, our optimal trading zones that may provide high-quality setups. The first thing we want to do is identify the market direction. Trading in alignment with the dominant side of the market increases our win rate. To identify the market direction, we look for break of structures, changes in character, and reversal patterns on the chart. If you can't clearly determine the market direction in a specific time frame, it's better to move on to the next pair. Unclear market direction in a specific time frame increases the risk of making uninformed trading decisions, so shifting to a clearer trend allows for better decision-making and risk management. Next, we identify liquidity levels on the chart. When analyzing, we treat traditional support and resistance levels as liquidity areas, especially equal highs and lows or multiple rejections, which are considered key liquidity zones. But why is it important to identify these liquidity areas on the chart? Liquidity is a key factor influencing price movements. The important thing to understand is that the market tends to move toward levels that contain liquidity. Conversely, the market tends to move away from levels where liquidity has recently been swept. With that in mind, grabbing liquidity before reaching an optimal trading area serves as further confirmation for the price to make the moves we want to see in the market. These key areas can also cause significant price rejections, so it's essential to secure some profits before the price taps into them. The final step is to identify fair value gaps and order blocks, which are our key trading zones. A fair value gap refers to the space between the wicks of 3 consecutive candles on a price chart. Additionally, we treat the candle that created this gap as an order block, as this is where decisions were made. It indicates a buy-side imbalance, where buying pressure significantly outweighed selling pressure, often due to institutional activity. When the market enters this phase of inefficiency, it typically returns to the fair value gap area to patch it. A conservative approach is to wait for the price to enter the order block zone before opening a position. An even more cautious method is to zoom into lower time frames, look for reversal confirmations, and then execute the trade. We'll dive into that now. The final step of this trading plan is to look for confirmations and execute the trade on the lower time frame. After waiting for the price to enter our trading zone, we need to see some form of confirmation that indicates the short-term downtrend is over and that the price can move to the upside. To identify this reversal, we pay attention to liquidity sweep patterns and changes in character. A valid liquidity sweep below the recent low suggests a possible reversal, and if the price breaks above the recent high, we have a valid change of character. Once the reversal is confirmed, here's how we execute the trading setup. We wait for the price to create an order block. This is why this strategy is referred to as order block within an order block. However, it's important to note that the lower timeframe order block does not necessarily have to be inside the higher timeframe order block area. After spotting order blocks on the lower timeframe, we set our buy limit at the start of the order block zone and place our stop below it. For the first target, we make our trade break even by closing half our position when the price reaches our 1 to 2 risk to reward target. The next target will be the first important zone ahead of the price on the higher time frame. Before diving into real chart examples, I want to explain some common scenarios that occur on the chart and how to handle them. In the first scenario, we have a very small order block area. When this happens, You should consider using a larger zone as your stop loss, as we want our stop to be protected from market fluctuations. In contrast, if we have a large order block zone on the lower time frame, the issue arises that if we set our stop below this zone, we will have a large stop loss. In this case, we can either take a smaller zone below the order block area as our stop, or set our order in the middle of the zone. This approach will significantly improve our risk-to-reward ratio if we end up winning. In the third and most critical scenario, we spot multiple order blocks before reaching our target. We will trade all of the order blocks that the market forms along the way, if they offer reasonable risk-to-reward ratios. The trades will be executed with reduced risk, so do not open trades with more than 2% risk of your capital, and never have more than 3 active trades at the same time. Remember, our focus is on achieving a positive result at the end of the day. Losing and missing trades are inevitable. After backtesting this strategy on the euro-dollar pair during the London and New York sessions, we have encountered many different scenarios that occur in the market. While this is not a real chart example, it is based on what usually happens in the market and how we take action. Here on the 1-hour chart, we can see that we are in a very smooth uptrend, so we are only interested in buying this pair. The latest move has created multiple fair value gaps, so we mark the candle before the imbalance as our optimal trading area. The general idea is to wait for the price to tap into this zone, after which we can zoom into the lower time frames to look for confirmations and enter long trades. But first, let's check the higher time frame to see if our analysis aligns with the bigger picture. On the daily time frame, we can see that the market has recently broken above an important resistance level, indicating that buyers are in control. Additionally, there is still plenty of space before reaching the next significant level ahead of the price. Therefore, our 1-hour analysis aligns with the daily time frame. Now, back to the 1-hour chart. As I mentioned earlier, we need to wait for a pullback to enter the order block zone, and then zoom into the lower time frames to look for confirmation of an upward reversal. So, let's zoom into the 5-minute chart. On the 5-minute chart, the market has already made a change of character, which is the reversal signal we were looking for. This indicates that the short-term downtrend is over, and now we can take long trades with confidence. Next, we simply wait for the price to print order blocks and open long positions. Here we have an order block created, so we open a long position. As the market pushes upward, we can see that another order block forms. So, without canceling the first trade, we will open another long position at the second order block. This approach is important because the pullback to the first order block is not guaranteed. The market can mitigate the second order block and start pushing higher. In the worst-case scenario, the price may drop and lead to 2 losing trades, which is why we must enter with reduced risk. Now let's see what happens. The price has hit the stop loss of the second trade and triggered the first one. Once again, we spot another order block. So, without closing the first trade, we set a long position at this order block as well. This process continues until we reach our target, which is the previous high on the higher time frame. This strategy has proven to be profitable, but make sure to conduct your own backtesting before trading with real money. This is the reality of the market. No matter how good your trading plan is, you will encounter many losing trades. It does not necessarily mean there was something wrong with your analysis. The key point here is to write down your rules and always follow them. As long as you stick to your risk management plan, you will be fine. So guys, that's it for this video. I hope it provided value to you. If it did, please go ahead and smash the like button to show your support. And if you're new here, consider subscribing to our channel. See you in the next episode.